Welcome back. Greek banks have been closed for nearly 3 weeks. The government now says they will finally reopen this Monday. But customers won't be able to take out all their money. Athens says there will still be limits on the amount of money you can take out or withdraw, which will be lifted over time. This coming as Chancellor Angela Merkel calls for, quote, European solidarity. Our next guest says the negotiating cycle may break down sooner than we think. Joining us right now is Paul Christopher. He is Wells Fargo's global market strategist. Paul, good to have you on the program.
Thank you very much.
No incremental new information overnight out of Greece, but it feels like the European zone has calmed down. Europe has been raging in terms of gains.
That's
right there. How do you want to look at this as an investor?
Well, look, this is going to be a story about the global recovery and the recovery in Europe. And the real question, the real risk for U.S. investors is, will Greece do what it did 5 years ago to global markets? We think the answer to that is no. So look through the headlines, focus on the economic recovery in the rest of Europe.
Does that mean buy Europe?
Buy Europe and Japan. We like developed market equities in general.
Paul, question. We were talking during the break. You take a long-term view for your investors. Don't you think Greece in particular has nowhere to go, Greece stocks, nowhere to go but up because all that risk now is factored in?
I don't think that's going to happen. What Greece reminds me right now of where Greece was in the fourth quarter of last year, first quarter of this year, where there was political uncertainty, instability even in Greece, and the Europeans pressing them very hard. I think that only increases, those two problems only increase as we go forward. So avoid Greece, but take that broadly diversified European picture, include the UK and Switzerland, too.
Okay.
What about the United States? Where would you put the United States with Europe and Japan? Are you as bullish?
You really have to rank the markets on the basis of where the earnings are coming from. That gets back to the recovery story. The U.S. is still the lead sled dog. We think Europe and Japan come after that, and emerging markets third.
Yeah, it's interesting because we had Jack Otter on earlier in the program from Barron's, and that's the cover story in Barron's this weekend. Let's show the cover again because they're looking at an opportunity to buy stocks in Japan, and Barron's is recommending that in this weekend's edition. Are we to say then that Abenomics is working?
No, it's not really there yet. They have yet to really develop the wage growth that we need to see for inflation to hit that normal 2% level on a sustained basis.
So what's the reason from your standpoint then to buy Japan?
I think it's going to be a foreign investment story in Japan. As the yen depreciates further, Japanese firms are going to do better in their earnings. It's going to attract foreign capital, including U.S. and European. That's going to be the entree for U.S. investors.
If the yen keeps going down, do you have to hedge out the yen then?
If we thought the yen were going to 140, 150, yes. If the dollar were going to be as strong as it was last year, yes. But look, our work shows even over a one-year horizon, and certainly over 5 or 10-year investment horizons, hedging doesn't pay. The dollar's still in a long-term downtrend.
Paul, you're avoiding the big elephant, though. What if the Fed starts raising rates and raising rates aggressively? Does that change any of your forecasts?
That would be a risk, but we think the Fed will be very careful. Janet Yellen and the rest of them have been very careful to signal that they're not going to be in a hurry. This won't be like 1994. It may not even be as fast as 2004.
What frothy parts of our market do you avoid here? You see some of these consumer names hitting all-time highs day after day after day.
You know, I think the thing that to focus on is in the U.S. market, the cyclical sectors. We like the cyclical sectors, those that are most leveraged to the progress of the economy going forward. I think if you stay diversified, that sort of concentration risk will be avoidable.
Which brings me back to second quarter earnings. And, of course, we had GE this morning. We had the banks last week. We got Morgan Stanley on Monday and a number of others. Google, obviously the standout stock, is up again this morning. Are there areas that you identify as a result of the second quarter earnings period that there's more growth than other areas? So where is the growth based on second quarter earnings?
We continue to think that the best sectors going forward will be information technology, industrials, and consumer discretionary overall, but avoid that concentration risk, definitely, yeah.
What about the flip side? What about bonds? What about, the financials, stuff like that? Any positions in those? Any future forecasts for those?
In terms of the bond sectors, we would underweight treasuries a little bit and bring duration in somewhat. We think once the Fed does start to move, even if it's very gradually, there could still be some volatility in the yield curve. So bring that volatility, bring that duration in a bit.
All right, Paul, good to have you on the show
today. Thank you very much.
Thank you so much. Paul Christopher, Wells Fargo.